Hello, everyone. Welcome back to the Dividend Uncle channel. Today, we're diving into a unique examination of CapitaLand Ascendas REIT, or CLAR, one of the most stable and well-liked REITs, not just by investors, but by analysts as well. As an investor who likes to challenge the status quo, I've scrutinized CapitaLand Ascendas REIT in Q1 2024, looking beyond its operational success to unearth potential risks and concerns. This year brings a substantial financial test with almost $1 billion of its debt coming due amidst an environment of rising financing costs. Before we delve deeper, do me a favor and hit that like button and subscribe if you find value in our deep dive analysis. Your support not only motivates me but also enables me to continue providing thorough and insightful content. Now, let's get into the details and see if a contrarian view holds up against CapitaLand Ascendas REIT's recent performance. CLAR's stellar performance in Q1 2024, understanding the strong rental reversions. In my quest to adopt a contrarian stance on CapitaLand Ascendas REIT, I delved into its Q1 2024 performance, aiming to uncover underlying risks that might justify a cautious approach. However, I found that CapitaLand Ascendas REIT showcased exceptional financial resilience, marked by a notable rental reversion increase of 16.0%. This is a continuation of the consistently outstanding quarterly performance in 2023, ranging from 10% to 18%. Let's take a look behind the curtains of the impressive rental reversions, breaking down the key drivers behind the top line. Market demand and supply dynamics. CapitaLand Ascendas REIT has capitalized on the robust demand in the logistics and industrial sectors, particularly in Singapore, where the logistics segment witnessed a significant 62% increase in renewal rates in Q1 2024. This surge is largely fueled by the expanding e-commerce sector, which demands more warehousing and distribution centers. Additionally, the limited supply of premium industrial spaces in key operational regions has led to upward pressure on rents, enabling CapitaLand Ascendas REIT to secure favorable rental revisions upon lease renewals. Strategic asset management. CapitaLand Ascendas REIT's management has adeptly navigated the market landscape by employing proactive leasing strategies. They've secured tenants well ahead of lease expiries, minimizing vacancy periods and leveraging favorable market conditions to negotiate higher rents. Furthermore, continuous investment in asset enhancement initiatives has significantly increased the attractiveness and functionality of their properties, supporting higher rental rates and enhancing property value. Economic and sector-specific trends. The broader economic recovery post-pandemic has led to increased business activity and demand for space, especially in the logistics and life sciences sectors where CapitaLand Ascendas REIT holds significant assets. The ongoing digital transformation and the boom in e-commerce have particularly bolstered demand for logistics facilities and data centers, enabling CapitaLand Ascendas REIT to secure higher rental revisions. Tenant mix and lease structures. CapitaLand Ascendas REIT's strategic focus on maintaining a high-quality tenant base, including high-credit tenants and essential services like data centers and logistics for e-commerce, strengthens its position during rental negotiations. The emphasis on securing longer-term leases also allows CapitaLand Ascendas REIT to negotiate more favorable terms during renewal cycles, contributing significantly to the strong rental reversion figures. Addressing potential risks, financing costs in focus. As we explore the landscape of potential risks facing CapitaLand Ascendas REIT, it becomes apparent that significant threats are somewhat scarce, reflecting the REIT's robust operational and strategic framework. However, one area that does warrant attention, especially in the current economic climate, is the impact of rising financing costs. With nearly $1 billion of debt slated for renewal in 2024 amid a volatile interest rate environment, the concern was legitimate. In response to these conditions, CapitaLand Ascendas REIT's management has projected that the average cost of debt could rise from the current 3.8% to a ceiling of 4.0%. This adjustment reflects a cautious yet realistic anticipation of market trends, acknowledging the potential for an increase yet keeping it within a manageable range. Quantifying the impact. To understand the practical implications of this scenario, we've crunched some numbers to estimate the potential impact on CapitaLand Ascendas REIT's distribution per unit, or DPU. Our calculations suggest that an increase in the average interest rate to 4.0% could lead to a reduction in DPU by approximately 0.31 cents, translating to about a 5% decline in DPU. This is a relatively mild impact but one that investors should consider. However, adopting a more conservative stance, suppose the interest rates were to climb higher than management's estimate, reaching around 4.2%. In such a case, the potential decline in DPU could extend to about 10%. There are two things to note from this outcome. Firstly, despite a doubling of what management expects to be the increase in average interest rates, the dividend yield based on the current share price would remain relatively attractive at around 5.3%. Secondly, this outcome is a conservative one, especially considering that the likelihood of interest rates peaking soon, and that further rental reversions are likely to offset some of this negative impact. The Dividend Uncle's take: evaluating CLAR's risks and performance. After a thorough analysis and attempting to approach CapitaLand Ascendas REIT with a contrarian view, I must admit, I was hard-pressed to find significant cracks in its armor. The results from Q1 2024 have only reinforced the REIT's reputation for stability and strategic acumen. Firstly, CapitaLand Ascendas REIT posted impressive rental reversions of plus 16.0% and maintained a high occupancy rate, despite a slight dip. These figures underscore the REIT's robust demand across its diverse tenant base and proactive asset management. Even with the looming challenge of renewing $1 billion in debt amid potentially rising interest rates, the management team has navigated these waters with a steady hand. They expect an increase in the average cost of debt but only to a manageable 4.0%, a slight uptick from the current 3.8%, due to conservative leverage ratio of 38.3% and 82.6% of debt fixed. Given these insights, my attempts at skepticism has turned into reaffirmed confidence in CapitaLand Ascendas REIT's resilience and prospects. The current 14.5% year-to-date decline in share price and a price-to-net asset value or NAV near 5-year lows present what I see as an attractive entry point for investors seeking stability in a high-quality REIT. In conclusion, while it's wise to approach investments with a critical eye, my analysis leads me to continue endorsing CapitaLand Ascendas REIT as a top pick for those looking for dependable returns in the right sector. As always, ensure you conduct your own due diligence, but from where I stand, the outlook for CapitaLand Ascendas REIT remains promising. Until the next video, happy investing.